In the second part of this chapter on prices and yields, we'll talk about some more detail, right? A little bit more complicated issues into how prices of bonds, etc., are created. So let's first think about the call feature that we'd mentioned a little bit earlier. A call basically is a way to refinance debt. So as interest rates fall, we know that bond prices rise. And a callable bond has a call feature, a call premium, if you will, that if the bond reaches that value, the company will call the debt. So there is a ceiling, if you will, for what the value of a callable bond can sell for. So if you look at this picture, right, at low interest rates, we're going to find that this bond, this callable bond, is going to flatten out and will never be higher than the call premium, which in this case, if it's a 10% bond, it's $1,100. But as interest rates rise, right, if interest rates are higher, it's just going to act a lot more like a straight bond, a bond that doesn't have this call feature, because the chance of call is relatively low. So we can see that the value, the straight bond, we had a picture earlier, so it is a convex curve, but when you add this callable feature to it, it alters the ultimate pricing mechanism and how the values are determined. So in this case, we have an 8% coupon bond again. It's going to be callable in 10 years, and the par value plus 1 year's interest is the premium. So in this bond valuation and duration worksheet, we now just add to it the call premium of 1080, and it's going to be callable in 10 years. When we do that, the yield to call is now 12.94%. So let's think about what this means for the investor. If you buy this bond today for $7.50, in 10 years, right, it's possible if interest rates fall far enough, the value of the bond will go up high enough that it will reach $1,080. If it would do that in 10 years, the company would call it, and if you still owned the bond, you'd earn 12.94%. So your question is this a good investment? Well, we already know that 10.8 is greater than 10. 12.9 is obviously still greater than 10. But the question is, what's the chance that we would get this yield to call? And the only way we would be able to add any information to that or any analysis to that is we would have to have some prediction of what we think is going to happen to interest rates. If you think interest rates will fall from 10%, if it falls far enough, now we're going to have a call, or a bond could possibly ultimately be called. The realized yield is another way of looking at returns or actually investing in bonds, and that is to set a specific time horizon. So we want to borrow, or we're going to buy some bonds, and we want this investment to be for a fixed period of time. Let's say 12 years. At the end of 12 years, this 30-year bond that we bought, we're going to sell it in 12 years. So at the end of 12 years, we'll sell it for whatever the price is in 12 years. So the question then is, what will the price be? If we were to say, look, we think that in the future, in 12 years, interest rates are going to be around 7%. What would the price be in 12 years if interest rates did indeed fall from 10 to 7%? Well, what we would have to do is just calculate the value. Now the required return wouldn't be 10, it would be 7. But let's not forget, this is 12 years from today, so that would mean that n then would equal 18. And if we did that, indeed the price then would be $1,101.45. So again, there are two cells to put this information in our spreadsheet. Now we find out that the realized yield to maturity is 12.46%. So what this tells us is if interest rates fall far enough, we might actually refund this or sell this back to the company in 10 years and receive 12.94%. But regardless of whether interest rates fall far enough or not, we're ultimately going to sell this in 12 years, and we'd actually be able to achieve or get a 12.46% investment return for this particular bond. Okay, so now let's switch gears and think about time for a little bit, right? What do we know about time and bonds? Well, when a bond matures, it's always going to be worth the par value because somebody's going to give you a check for the principal or $1,000. So regardless of what you pay today, the bond will ultimately be worth $1,000. What if you buy a bond at a discount? Again, if you buy a bond at a discount, say around 57% of par, eventually it's going to be worth $1,000. In this case, this is a 4% coupon bond. If you buy the bond at a premium, eventually it's going to sell for $1,000. In this case, this dark blue line represents a bond with a 12% coupon. So it brings a question, I guess, if you really don't understand why people buy bonds, is why would you ever pay more than $1,000 if you're lending somebody $1,000? Well, you do that because the coupon they're paying is in excess of the par value or the yield to maturity that you want to receive. So this person has or needs cash. They're paying for the benefit of receiving cash currently rather than waiting longer to receive their cash. What about zero coupon bonds in general? Right? There are some corporations who have issued zero coupon bonds from the start. Typically, though, these are really treasury securities. And the basic idea is there's no cash flow until maturity, and then they essentially are going to be sold at a very deep discount. Now, these bonds can be issued as zero coupons, or there are brokerage firms that may create these zero coupon bonds. In fact, they refer to them as strips. So they will take these treasury bonds and they will create two securities from the one instrument. So they'll have a coupon instrument and they'll have the zero coupon principal component or piece. Now remember, both of these are still risk-free investments. There could be people who want a risk-free capital gain based on the zero coupon concept, and there will be some people that want a coupon that is risk-free, and they don't want the capital gains piece. Now, these types of instruments do have special kinds of tax treatment. So the IRS recognizes that wealthier people may take advantage of this, so they have put in place some special rules as to how taxes are actually computed over the life of these types of bonds. The next thing to kind of explore a little bit about is the concept of default and what it does to bonds. Now, we do know that bonds are graded, right? There are ratings that they receive. Highest ratings are AAA or, again, depending on Moody's, capital A with two little A's. Investment grade then bonds are typically your BBB bonds and above, and speculative grade bonds are below BBB. So we have these categories. Now, the importance of these categories are they are measurements, or they are based on the chance of default. So AAA rated bonds have the least chance of default. They are the least risky of all the bonds. So in relatively speaking, if they're the least risky, they're going to be the bonds that have the highest prices. And of course, vice versa for speculative grade bonds. But how do they ultimately get these grades? And these grades are all determined by a financial statement analysis process or project. There are 5 basic categories of ratios that have importance with respect to bankruptcy. The coverage ratios, right? The ability to make payment on debt. Leverage ratios, how much debt the company has. Liquidity ratios have to do with how much cash is on hand. Profitability, obviously, is how much profits are generated by the company. And in the end, we have cash flow to debt ratios. Again, this is a kind of a coverage kind of ratio. How much cash do we have compared to how much debt do we have? And how this is ultimately created is through a statistic, and we'll talk about that in a second. But here's the outcome of this analysis, if you will. Here we have our ratios. There's 1, 2, 3, 4, 5, 6. There are 7 ratios here that are all measured or all have some influence on default. So EBIT, right? Earnings before interest and taxes to assets, right? This is our basic earning power ratio. If you notice, AAA rated bonds are roughly around 20.9%. BAA bonds are 10.9. C bonds are 4. So as we go down the list, right, the top 3 ratios here, the basic earning power, operating profit margin, and a coverage ratio, the smaller the number, the greater the chance of default. And exactly the opposite is true for the other ratios, right? The greater the number, the greater the chance of default. So as we can see here, these ratios do have some influence on exactly what ratings the company gets. And this research came from the guy's name is Edward Altman. In 1966, he created this thing that's referred to as the Z-score, and it's created through a statistical procedure. It's very similar to regression. It's actually referred to as discriminant analysis because it discriminates between 2 things. Discriminates between those companies that go into bankruptcy and those that are considered safe. And through this statistic, much like in regression, we end up with a formula. And for Altman, what we find out is if the value of this formula, if it's less than 1.23, this company is vulnerable to bankruptcy. If it's greater than 2.9, the company is considered relatively safe. So let's think about what happens to banks, right? Banks have hundreds and hundreds and hundreds of applications for debt. How do they analyze each and every single company, right? Do they want to analyze each and every company? What they might do is a company comes in, they calculate this Z-score. Anybody that has a score over 2.9 automatically gets the loan that they want. Anybody less than 1.23 is automatically rejected. Their loan is turned down. So that means the only people we have to investigate are those people in between those 2 numbers. So it could save the bank a lot of human capital and just resources in general from analyzing companies. Now, there are also retail bankruptcy predictions. And this, again, is an example of one of these retail Zs. Again, in this case, if the Z-score is less than 0, failures predicted. Greater than 0, there's no bankruptcy suspected. Again, one of the important things to this is the one and only study that has ever cited my dissertation. That it was based on this idea that there are things and variations on financial ratios that might be just as important as in the Z model, the actual static numbers. So again, with respect to me, I think it's a very important study on prediction of bankruptcy. Thinking about this risk then, the default risk, as you might surmise, there's then a difference between returns and the risk level. AAA rated bonds are the least risky. This black line is the yield spreads, is the yield every year between a AAA rated bond and a 10-year treasury. So they just find the average rate of return on a AAA rated bond, and from that they subtract the rate of return on a 10-year treasury. And as you can see, as the risk goes up because the ratings are going down, we see that there is increased spreads, increased values of return based on the risk levels. Now, do the owners of these bonds actually receive these yields? And the answer is it depends on what happens to the company, right? It depends on whether or not the company defaults or not. So how do bondholders protect themselves? Well, there are 4 basic ideas or ways we could do this. One is something called a sinking fund, and this is just a process of systematically putting away money every year so that when the maturity time comes from the bond, there is enough money left to make payment to the bond holders. Subordination of future debt means it's going to restrict the additional borrowing. So again, people will not want to lend you money if they have to stand behind others if trouble comes along. So subordinating debt means, look, you can't put anybody ahead of me. They've got to go to the back of the line if they're going to get payment. Dividend restrictions can obviously help maintain cash to make sure we're not paying too much out to our shareholders. And of course, we can ultimately require collateral. Frequently we do this, the types of bonds are going to be more of a secured bond, right? They're going to have things like mortgages and portfolios and maybe equipment as collateral for the bonds. So in the end, if you think about what's the connection between yield to maturity and default risk, the risk structure of interest rates refers to the pattern of these premiums. What does that yield spread thing look like? All right, there's a difference between the yields that are based on expected cash flows and promised cash flows. Promised is what the contract says, but expected implies that there's a chance of default, and we need to incorporate that into our structure, into our analysis. So the default risk premium is the difference between the expected yield to maturity and the promised yield to maturity. In other words, that difference is what you want to get paid just in case the company goes bankrupt and defaults on its debt. The last thing to talk about, I want to talk about this briefly, are things called credit default swaps. And the reason I think it's important to mention these, and we're not going to get into a lot of detail about the mortgage crisis, but essentially credit default swaps, in my opinion, is probably what created most of the problems in the banking industry when the mortgage crashed around 2008. Now, the banks were in trouble already. So they were doing some things that they shouldn't have been doing. But these credit default swaps were a security that they were using like insurance. So they were taking on bad debt, and then they were writing insurance policies against that debt. So essentially what happens by buying these insurance policies, what we were able to do was to enhance the credit worthiness of our loan portfolios. So maybe we had bonds that were C-rated bonds, but because we took out this insurance, essentially the bond ratings went from C to maybe B or double B, right? So essentially what happens is this creates this sense of feeling of security. The challenge is what happens when bonds start to default, right? These obligations, right? These credit default swaps and obligations, essentially what happens, we created these other investment vehicles, right? And these vehicles were basically loans that were all stuck together. So imagine you had a whole portfolio of bonds. We had $200 million worth of bonds. There were really good bonds in there, very safe, very good borrowers in there. And then there were also the very risky borrowers there. People that might not even be able to make mortgage payments. But we put all of those together in one big batch. Essentially what we did was we made gravy, right? So all these things are put together, and then we created an instrument called a collateralized debt obligation. So the bank takes these vehicles, right, and they create these other instruments, and they divided them into these parts. So these parts represent pieces of all the different bonds that are in there. So again, this senior tranche that they talk about is 70 to 90% of notional principal, and its coupon. These are going to act like AAA rated bonds. These are going to be a little bit lower grading, and then at the very bottom there's another tranche, and these people are going to earn different kinds of investments. Now the challenge was not so much that they created these weird entities here, but there was no mechanism in place to properly price those securities. This part of the security industry was for the most part unregulated. So there was no structure as how to create prices. So yields did not relate directly to risk. And in the end, when banks started having some issues because people were defaulting on their debt, this is when we had the big crash. So again, that's the end of bond prices and yields.